My first guest says that 2025 provided the perfect setup for a strong 2026. Joining me now, Evans May Wealth Managing Partner, Elizabeth Evans. And Elizabeth, before we even get to some of your ideas here, I want your thoughts on today's session. You know, we kind of see it's interesting. Some green on small, some green on mid caps, large caps have done extraordinarily well. This is even a better zoom of it. So, I mean, is this something that you anticipated, more some sort of rotation? And could this be sort of a blueprint for the year?
Well, Charles, time will tell. This morning we saw CPI and PPI numbers that came in, and the read-through on PCE. Some of the data points that feed into PCE really indicate that maybe we have stickier inflation, and so the concern is, does the Fed continue to pause? So I think that's creating some of the volatility. But as we look at this blueprint, we still think that the leadership remains concentrated in mega cap technology. But we do think, unlike 2025, we will start to see a broadening out.
Let's talk about that, right? Because you have pushed back against, let's bring up your 2025 stuff here, a reflection. The soft landing, solid growth, moderating inflation, strong equity performance. That's sort of the runway as we begin this year.
Yes, so we really delivered a soft landing in 2025. So you had really strong equity growth. You had both the S&P and the Dow double-digit returns again, real GDP plus 1.9%, core PCE coming in at 2.8%, expected to be at 2.4% by the end of 2026. So earnings hung in there. We saw earnings growth tracking at 12%. All of that to say that it's a very good setup going into 2026.
And you push back against the notion, again, that, this AI bubble. You've been pushing back against that. You're saying it's not the exuberance we saw in 2000. These are some of the differences here on the screen that you share with us.
Yeah, so short interest is still high, 88th percentile. If you look at the equity inflows last year, they were relatively subdued. You had 100 billion flow into equity mutual funds and ETFs. Compare that to 1.6 trillion in money markets and fixed income.
Right.
So we're not, there's
not this mania out there.
No.
There's definitely not a mania out there. By the way, the PE expansion that you see before every top, a gazillion percent up. We were flat on some of these, the mega cap names. So let's talk about areas to watch this year. We're going to bring that up as well from your notes. So you like the mega cap techs, but you also mentioned regional banks and defense sector. What is it about regional banks?
So financials is interesting to talk this week with earnings season. So if we look at the KRE and overlay that to the KBWB, so the regionals to the big money center banks, regionals have underperformed the big money center banks by 20%. So we think that there's a catch-up trade to be had there. We know financials do well as credit concerns continue to lessen. Yield curve is steepening. So we're in a deregulatory environment, so there's a lot of positives for financials.
Okay, and we know the defense sector. I kind of think that speaks for itself. I want to give you a shout out here. One of the ideas you gave us more recently, HII, this thing has gone parabolic. It's a number 5 percentage gainer this year coming into the session. A stock like this that you liked a few months ago, do you hold this? I know you're mostly a long-term buy and hold, but this has made a monster move.
I know, 49% since we talked in September. So yes, we still think that we know from the Trump administration, especially in the last few weeks, they're very committed to military capabilities. Huntington Ingalls has a duopoly in Navy shipbuilding, and that is a part of military capabilities that the Trump administration is super focused on.
All right. Before I let you go, then let's look at some fresh ideas, more or less fresh. Google, listen, we talk about it almost every day. You can't not talk about it. Last year it was deemed the winner over OpenAI. Obviously, you think it still has more upside.
We do. It just hit 4 trillion now, surpassing.
So 5 trillion is right around the corner.
It's right around the corner. No, I think that there's still continued upside from here, and so they're doing a lot of things right. So yes, that's one of really our top mega cap tech pick for 2020.
I think everyone knows the Lilly story. They kind of beat Novo last year, whatever. It felt like there was a nip and tuck race, and then of course they kind of took off, and they have had so much more success. But with just about 30 seconds ago, I'm intrigued with your Baker Hughes play. Obviously, the Venezuela situation, everything changed. Everyone's kind of talking and looking at energy and oil more closely. Why this specific play?
So Baker Hughes is not your traditional oil field services provider. So if you look, this company is quietly becoming really an industrial energy and infrastructure play, but it's still trading like an oil field services company.
So that will command a higher premium?
Much higher. So right now it's trading at 9 to 10 times EBITDA, which is what you would expect from oil field services.
Right.
The industrial energy and technology business is also almost in parity with, from an earnings standpoint, with their oil field services. So we think that there's going to be a gap up that investors can participate in.
Great stuff. Great having you in the studio.
Thank you, Charles. So good to be here. Thank you.
You've been killing it. Thanks a lot. Appreciate it.
Thank you.
All right, folks. You know, interesting enough, my next guest also reflects on 2025 and how it will influence this year. I want to bring in Roundhill Investments, their CEO, Dave Mazza. Dave, we've got a quote from you here, 2025 defined by tariff fears, expectations on the Fed easing cycle, resilience, and the AI trade. And essentially, you talk about that, but you also mentioned from a technical perspective, the market appears to show signs of resilience as well. All seems like pretty good stuff. Engines go.
Well, yeah, it's interesting. I think if you just read the headlines, whether it's the newspaper or watch enough shows, you're going to be really fearful and think that earnings must be horrible, the economy's...
You're going to watch it from a bunker,
right?
A foxhole every day.
Exactly.
Unless you're watching me.
Well, that's a good point. But here's the thing. Corporations were incredibly resilient. If we look at the earnings growth relative to revenue growth, that shows that there's productivity happening. So actually, I think what we may be seeing with the AI story start to play out is actually U.S. workers are getting more productive, and that's helping earnings.
Let's talk about this rally. A great chart in your piece, just really illustrating the fact that maybe talk of the AI bubble or the market bubble is a little premature here. This is some previous bull markets. Looks like if using this as a blueprint, a template or whatever, we got a long way to go.
Yeah, look, history doesn't repeat, but it can rhyme.
Right.
And this is just a setup to give some context, because again, we were kept hearing from our investors that they're nervous and they're scared. But if you look at the data in its context, this bull market is not crazy exuberant. Doesn't necessarily mean it can't stop being a bull market, but at least based off of history, there's still some room to run.
Let's talk about another thing that we've seen here recently. A lot of false starts last year. You know, we talked about the concentration, but this time around, you can see going back to just sort of late November, we've really started to broaden this out. Like the names over the 200-day moving average, over 62%. This is for you a bullish signal? Or at least a positive sign?
It's definitely a positive sign, right? So we've heard, again, about the concentration in the Magnificent Seven and the impact on markets, concentration in revenue, concentration in earnings. But if you, again, use the data to tell your story, and what we're seeing is that actually there's a greater participation of breadth from the number of names that are actually doing well. And to me, that's a sign of a relatively healthy bull market.
Yeah, no, you got to be excited about this. Okay. ETFs, we don't do a lot of ETFs in here, but you shared some intriguing ETFs. We couldn't put them all up, so these were the three I wanted to ask you about, starting with Chat.
Yeah, Chat's actually an actively managed ETF focused on generative AI. So that's ETF up about roughly 50% in 2025. And really the idea with this ETF is not just to own NVIDIA and AMD, but own the full stack. So you're going to have NVIDIA, AMD, but also complemented by names that we added like Samsung and Micron, which have had exceptional performance as the AI trade begins to broaden out, not just from the chips, but into memory names and others.
I mean, we know MAGS speaks for itself, but MTEV, is that a play on Meta?
This is a play on the metaverse, so which in some ways is a play on Meta, so it's a little bit broader, and of course they changed their company name reflective of that, but the metaverse was a theme that a few years ago people were talking about, and it was going to be transformative for the internet. But again, performance-wise, it quietly did really well last year because what the companies are doing by integrating AI into this build out of making sort of an ecosystem that from a digital point of view is actually very powerful. So we think all three of these have long-term potential.
And we got a minute to go, a minute left to go over your stock picks. I think Google kind of speaks for itself. We just, you and Elizabeth Liken and maybe another 7 million people. Apple's the one though, right? It's a love-hate relationship. A lot of folks on the street don't think their AI game is up to snuff.
Look, and it probably hasn't been, but they partnered up with the name right next to it, Alphabet, most recently. They didn't choose OpenAI. They could have chosen another competitor, but they went with Alphabet and went with that large language model. And I do think that this is finally going to be what Apple needs to kind of be looked at more credibly from the AI side. The other benefit with Apple is, of course, it has not spent nearly as much as all the other hyperscalers. So there's a lot more cash on hand for it to kind of do things in the future.
And let's face it, that the last iteration of their iPhone was enough to make the stock do very well last year. They always have time. They never have to be first. We know that. Less than 30 seconds. Micron, I'm in it as well. My subscribers. It's had a hell of a move. At some point, the shortage of memory and storage, that game plays out. But a lot of people don't think that'll play out until maybe 2028.
Yeah, it's interesting. This is a business that was super cyclical that's becoming a non-cyclical one with structural demand. One of the reasons why the stock has looked so good from a chart perspective. To your point, it's kind of had a great run, maybe a bit overextended, but longer term, there's such demand for memory as we see the AI data center build out continue.
Dave, great stuff, my man. Appreciate you. Thank you.